This is your host, Stephen Sargeant. This is a world-class episode with William Quigley. He's the co-founder of Tether, early investor in things like PayPal and Ethereum, and he's also the co-founder of WAX, the blockchain for everything tokenized, whether it's in-game skins all the way to NFTs. We talk the whole gambit. We go back and talk about what VC was investing like in the 1990s and how there might be a move towards hardware versus software in 2025. We talk about the early days of crypto and Tether. We talk about how the hype cycle in the NFTs and what went wrong, and how speculation has led much of the crypto and blockchain industry, and what we can do to bring the industry back to utility. We talk meme coins and Solana. We talk about transactions, millions of transaction volumes for some of the biggest blockchains in the world. And we touch on regulation. Although he doesn't like the word regulation, we talk about transparency and responsibility in the crypto space. This is one of our favorite episodes. This is the second time William's been on the show. And it seems like every episode, the conversation with him gets better and better. And he's the builder in this industry since the early days. This is a must listen to podcast. Let us know how we did and enjoy the show. Welcome to Around the Coin. I'm your host, Stephen Sargeant. This podcast is extra special because we have a featured guest, one of the most downloaded guests. We have William Quigley, co-founder of Tether and the WAX blockchain. William, for those of us that haven't listened to the first episode, which everyone should definitely run to and get it, that was 3.5 years ago. A lot has changed in blockchain, Ethereum, crypto, stablecoins, NFTs. We're going to go down the gambit, but give us a little bit of refresher of who you are and what you're working on now.
Okay, well, I guess briefly, I was a venture capitalist for many years. I started with two other co-founders, the first consumer internet-focused VC fund in the mid-90s. And a lot of what I thought about where blockchain would go came from that early experience in focusing on the internet, where there was a layer of infrastructure, then a layer of applications, and then a layer of reporting and analysis type companies, and then payments and so on. So prior to that, I was working at the Walt Disney Company in the late 80s and early 90s. And then I got involved in a lot of the video gaming world. It was really the gateway to me getting involved in crypto. In the late 90s, the idea of trading video game virtual items became a thing with really, I think the first game was Ultima Online, first game in the US. It was already being done for a while in Korea. And so my partner started the very first marketplace that allowed people to buy and sell video game virtual items. And he used a company I had just invested in as a startup called PayPal, because prior to that, there was no real way to pay online in order to buy and sell stuff. People were very nervous about doing things like credit cards. And if you go way back to the early days of eBay, people would mail checks, which is insane, right? And so a lot of people probably don't know this, but many of the early adopters and users of crypto, initially Bitcoin, came from my industry, the video game item trading industry, because video game items became a money substitute for many people around the world who didn't have access to banking. And it's a little less talked about now, but probably for the first 10 years of crypto, I would constantly hear people say, well, why would I need to use crypto? I have a credit card, I have Venmo, I have PayPal or whatever. And my answer was generally, you shouldn't use crypto. You don't need it because you're one of those privileged few in some Western countries where banking access is easy. But for billions of people, banking is terribly difficult. And even if you get a bank account, a lot of times in those countries, your assets are seized or the currency's devalued. So for people who are from the US, I think that was one of the reasons why they had a very difficult time understanding why this was useful. But I had seen it because we allowed people in 100 countries to buy and sell video game virtual items. And I noticed how hard it was for many of those people to get access to reliable payments. And so we've done a lot. My partner and I have done a lot in the crypto space. We started like everybody else with mining. And then eventually, I'm still annoyed that I didn't think of the idea of using ASICs instead of standard computers to do mining.
Did
But
you
then we
see
got
those
in.
in the early days? Did you see like early ASICs and just kind of like thought of it like, oh, or do you look back now and say, oh, what a competitive advantage those would have been if I had
Well,
just adopted them earlier than I
I
did?
yeah, I'll tell you, I was venture capitalists have a lot of scar tissue, right? And in some ways, it's a curse. And for me, the curse was that I had invested in like I think 4 semiconductor companies. And I didn't like investing in semiconductor companies. These were communication chip companies, extremely complex and frankly, not great investments. And if when I'm giving lectures to young venture capitalists, I explain the difference between investing in an app and investing in a semiconductor. But suffice to say, you have to spend a lot of money upfront and wait years before you even know if the thing will work. And so with a lot of software-based companies, we spend very little. We kind of see if it works. And if it does and you start scaling, then you pile money in. But that money now has a lot less risk attached because you know you're acquiring users at a certain price and all that. By the way, this is why the VC industry really abandoned what you might call hard tech for almost 20 years. VCs didn't want to touch it, and for good reason. It was way easier to back 2 random guys and an app and make $1 billion.
Right.
But we've milked that now for 20 plus years, and we need a whole new generation of hardware. And that is becoming, I think, an area now where VCs have returned. But they're going to see, the young VCs are going to see how hard that really is, right? Famously, people talk about how, Elon Musk had no competition when it came to SpaceX because that was beyond like traditional hardware. That was like science, right? Nobody really wanted to touch it. But if you have no competition and you're aiming at a very large market, the value is if it works, you have an incredibly valuable business. If you're in a traditional kind of easy to build software based type of business, it's nice because you don't have to put a lot of capital up front to go after it. But the downside is you have massive competition very quickly if it looks like what you're doing works.
Is there any hardware that you can think of off the top of your head? Obviously, AI has helped from the software side. You have 1, 2 people teams able to build tens of million dollar business rather easily without having to hire expensive CTOs or developers using AI. Is there any hardware angles that you see where people are like starting to move towards, or any kind of industry that you're like, oh, these hardwares are
Yeah.
like very interesting to invest
Yeah. I
in?
mean, like I said, the first one, semiconductors. Semiconductors were like redlined by VCs for so many years because it was so hard to make money in that space. But probably aided by the boom in AI and obviously NVIDIA becoming the most valuable company, for a time, being a semiconductor company, that blew VCs away, multi-trillion dollar valuation for that. So now there is a huge push. And you have companies, for instance, like Intel, which, when I was younger, Intel was like, consider it sort of like a Google or an Amazon. It was hard to imagine any future where Intel wasn't the dominant chip manufacturer. And Intel, NVIDIA could buy Intel with like 2 weeks of cash flow now, right? So it with Intel's collapse, it's still around, but they don't have a lot more chances to try to reposition. I think VCs got a little scared. It was like also in the 90s, a lot of office type software, office productivity software. If Microsoft didn't want people investing in it, they would just release like a PowerPoint saying, this is a new area we'll be going after. And everybody was like, oh, I don't want to compete, with Microsoft. Well, that was how people felt about Intel. Now Intel is, a shadow of what it was. And so Yeah, you'll have a lot more semiconductor investing. Other areas, robotics, a tough area, very expensive to build and still early. And of course, the final product is very expensive. So, but there will be investment in that area. I would say all forms of materials, the material science area is underinvested. And now a lot of people are seeing all of the things we need that we don't have. And so I suspect that will be an important area. If you look at something like virtual reality, the types of headsets that we use, the glass or the viewing screens, that's another area where there's probably a lot of advancement. And then of course, an area that I think has not been fruitful, but everybody knows the problem would be in battery technology.
Right.
It's an area where there's been lots of money invested and not great returns. And because there's physical limits to what you can do. But again, anybody who thinks about virtual reality, the thing that any company hawking a virtual reality headset tries to Photoshop out is the weight belt of batteries that you have to carry, right? And so wireless as well. Wireless covers a lot of different areas, from the actual transmission capabilities, antenna kind of capabilities, to what we call propagation modeling, which is figuring out how to optimize a layout of a wireless mesh network. And then of course the RF baseband chipsets, which have been dominated by a few very valuable companies, but the IP there has been very hard to crack because again, you're dealing with physics. And so I would say these are like a handful of the areas in the hardware side that will get a lot more attention. Obviously in space as well. I mean, Elon has kind of two angles there. He's got the delivery vehicle, which is SpaceX, and then he has the kind of the application network, which is Starlink. And the idea of a private company doing that for many, many years was like, no, because there were attempts in the 90s. Lucent, Motorola, they tried and they spent a lot of money, but it was too expensive basically to get a satellite in the air.
Right.
And I think that was Elon's real innovation to the satellite business, was getting the deliveries done cheaply.
I
But
love this. I have to interrupt because you mentioned in-game is where you started, especially around the marketplace. Roblox is probably, when people talk about metaverse, they all many people don't talk about the metaverse anymore. They refer more to like, Roblox and the universe it's created. Is there
yeah,
any major game marketplaces now? It doesn't seem that anyone jumps out at me. My son's on Roblox, both of them. I don't see any, big companies well branded in this space. Has much changed in the last 25 years since you rolled out your marketplace?
surprisingly, not a lot has changed. Very few gaming companies. We were always at war with the gaming companies because very few of them liked the idea of the players being able to trade their in-game items. They
Right.
just didn't like it. And most of them had a view that they wanted to be the monopoly of all commerce within their game universe. I always found it kind of amusing too, because a lot of these video game developers and companies are very capitalistic, you know, but man, do they love monopolies. So the challenge has been, and you saw this in blockchain-based video gaming, which is still hasn't hit sort of the mass market consumer adoption phase, because I think the challenge has been, what is the economic model for the video game publisher with virtual items other than just selling them to you and letting you
Right.
use them? Is there an additional model where these things could be freely moved around? And most video game companies have taken the view that any dollar captured by people outside of their game universe is a dollar they lose.
Right.
And
Because if they wanted to trade, they don't want them to trade. They just want them to buy. Hey, you want a skin? Buy a new skin. Don't trade for somebody that's already bought a skin. I'm
yeah,
assuming is
that's
their
that's
perspective.
right, right. And then you get, I should mention, it's not just the game publishers. There is these dogmatic views in video game players that the buying and selling of virtual items is an awful thing. Now, you could more persuasively argue that point when the trading was with virtual items. And to your audience, some are probably gamers, some aren't. Virtual items were in game items that provided some form of utility for the player. And so often video game players said, oh, this guy didn't earn, this virtual item because he just bought it from someone else. So that's not fair. But let's face it, if anyone is involved in sports, you know that with money you can buy a good team, right? But let's say that's a legitimate argument. The argument really falls apart when you get into skins, and a skin, for your audience, is a in-game item that has no utility. It's strictly for cosmetic value. And so it doesn't boost your ability in the game. It's just
Right.
an avatar cover, if you will. In that case, not allowing people to buy and sell is harder to understand. But I have come away with a view. The reason video game companies suppress that and don't allow it is because they can. They control the universe. So my view is, let's take the most controlling company I know, which is Apple. Apple lets you sell your phone to people or your laptop, but I would say they do it because they can't stop you.
Right.
If they could stop you, they probably would. If Nike could stop you from trading your sneakers, they probably would. They would want to capture some of that. So video game companies just happen to be in a position where they can prevent people from trading assets, and so they do. And the challenge for blockchain video gaming is to contribute something to the gaming experience that you can't do without a blockchain. Now, one thing is allowing people to freely trade, but as we just talked about, traditional video game companies could do that too. They just have decided they didn't want to. I do think there's a subset of players who would like to do it, but an age-old problem with blockchain is the fact that it's inconvenient, and by that I mean it's difficult. The user interface is not great, and probably until that is overcome, blockchain-based video gaming will not hit mass market adoption.
We did see it pick up a lot with NFT gaming, but I want to talk to you about the early days because you have been in crypto for so long. You've invested in Ethereum early on, incubated Tether, and became a co-founder. Now we're seeing a lot of people look back on some of these companies early on, which like, oh, they didn't do it properly, they weren't following, proper protocols. But without these early innovations, without them pushing the limits, we wouldn't have, ETFs, we wouldn't have, institutional adoption. How do you balance that? Like we had to kind of do things a little bit shady early on in order for us and our customers to keep their bank accounts at banks with we still led the path to the innovation that we're seeing today.
Yeah, the crypto was, I suppose in some cases it still is, what we would call a gray market. And a gray market is simply a market that an industry where the established rules of the real world haven't yet been created. And some industries never leave the gray market. The video game virtual item trading was kind of like that. But the benefit of a gray market is that all the W-2s who work at big companies have no desire or ability to look at a new market when there aren't all these guardrails and instruction sets, about how to operate in that industry. So they stay out of it. And that allows the entrepreneurs, the early stage companies, to take a dominant position. And obviously the internet being a great example, but mobile as well. Mobile adoption was mostly, and I'm talking about the app side, was all new companies. So if you were waiting around in 2010, 11, 12, 15, 17, even 20, for somebody to give you an instruction manual, you were never going to do it, which is why most large companies just didn't touch blockchain. And then you had a sort of a rear guard action by the financial institutions of the world to denigrate blockchain and crypto. And their reasons for doing that was they saw it as a threat, but they didn't want to go into it themselves. If they knew of an obvious way to make money and do it, I think they would have not talked mad shit about it. They would have just done it. But they were, W-2s aren't terribly innovative, right? So they just sat there and said, let's just try to put a lid on it. And that's what they did. It's what I would say is the difference between the rollout of the consumer internet, call it mid-90s onward, versus crypto. There are similarities, but the differences are striking as well. There was no established industry agitating for restrictions being put on the internet. It was just seemed kind of gimmicky and sort of a waste of time. When I left Disney and started my venture capital fund, and it was the first one targeting consumer internet, most people just sort of felt sorry for me. They're like, wow, you're leaving behind a great career for this fad that has no value, right? And that was fine because there was a whole bunch of us who said, great, just leave us alone. And then at a certain point, as industries started to crumble, traditional industries, because of the obvious value you could get from doing it on the web versus doing it in the analog world, all the big businesses started saying, oh shit. But for the most part, if you think about it, the largest companies in the world now are sort of internet-based businesses. Right. The traditional industries never could adopt or adapt because it was too late for them. So you compare that to crypto. What the financial services industry did effectively was they got the government to restrict usage, to sue people. In the US, we had this army of regulators who had no congressional mandate to do anything regarding crypto, but they took it upon themselves to try to kill it off. And they demonized it. It's not as common now, but for many, many years, if I read anything about Bitcoin or blockchain, in the same paragraph, you would have the words money laundering, terrorist financing, tax evasion.
Yeah.
It always, right? They would have to put that in there. And it's for this reason that it really stifled, I think, the adoption for a long, long time. And of course, with the Trump administration being pro-crypto, that's going to start to change. But one of the things that I don't like about what happened was there is a learning curve in when any new innovation comes about. There's a learning curve. When startups jump into it, and as I mentioned, they do it before the big companies, the people in those startups learn a lot, and often the established companies never catch up. So there's a reward for being first or being early. Will kill you in the startup world is if something, a government agency or collection of industries, can suppress your innovation until they have enough time to learn, right? And so, you've got guys like Jamie Dimon at JP Morgan, who for years was saying, I'll fire anybody involved in blockchain and crypto, it's bad. But if you looked at the patent filings, they were filing shit tons of patents around blockchain. So, he was saying one thing, but he was doing another. So it was a very clear-cut example of using the forces of his industry and the government to suppress the industry, the crypto industry, until they had enough time to catch up and figure out how to exploit it themselves.
Right. And you mentioned up until 2020, we saw 2021 was kind of like a coming out party for
Yeah.
NFTs, DeFi, crypto itself. 2017 is really, I think, when crypto and especially Bitcoin got on the map. But you started, an NFT marketplace and an NFT, blockchain pretty much,
Yep.
WAX, right in the heart of, 2021. You look like a genius. But then within 12 to 14 months, the craze of NFTs dies down. What were, maybe before we even get into that, I think one of the points you made on the last podcast was the difference between tokenization and digitization. Maybe this
Mm.
level set and give us a brief explanation on the difference of two, because I think that, trips up a lot of people, especially when they think of NFTs or even stablecoins for that matter.
Right. And you could spend a lot of time on this. So let's try to do it briefly. First, just you saying that is good because people can do their own research. But I would say, maybe this is an exaggeration, but 95% of people in crypto don't understand the difference, let alone the mass market. The mass market is hopeless. Most people understand the concept of digitizing something where you allow people to electronically send a record, a piece of music, whatever, do a payment, right? You're updating all these digital files. Well, that works, but the problem is what you're really doing is you've got databases in different locations, different servers, and people are in the digital world sending an instruction to, if they meet the right requirements, change this number from a 1 to a 2 so your bank balance goes up or whatever. It's generally centrally controlled. And it is a digital file can be changed as long as you have permission, right? And it can be copied. You can take an emoji, you can copy it and send it. And there's no way to tell what the original version of that emoji was versus the endless copies that are out there. And of course, this has created all kinds of problems with things like music. So once you start building on a blockchain and understanding how Merkle trees work and whatnot, the intricacies, you really start to see how tokenization differs so much from digitization. When you tokenize something, I like to think of it as you put this digital file in an envelope, and that envelope, this software-based envelope, has a set of properties. And these properties are that you cannot make any edits to that thing once that thing is done, because it's been encrypted to maintain its state. And as a result of that, when you send this tokenized asset from one person to another, there's a beautiful thing that comes out of that, which is that the recipient knows with certainty, instantly, and at no cost, that the thing they got is genuine. That's what makes tokenization different from digital. Digital is an electronic file that can be changed, and unless you put in specific rules behind that, no one can know that it was ever changed. Whereas when you tokenize something, which the best way to think about it is you put it in a wrapper, you put it in an electronic envelope, it can never be unsealed, it can never be modified. And that is what blockchain-based items are. They're tokenized. And that is the contribution. It was very confusing to people, and it still is early on, when, for instance, I was trying to tout the value of a Tether or a Bitcoin, and people would say to me, smart people, they'd say, but William, great, you've digitized the dollar. Congratulations. That's been done for 60 years. And by the way, a lot of crypto people would say this to me. And I'm
Probably
like,
even
no,
worse with
no.
NFTs. I think that whole right click and save army was like, well, I have a digital picture. Who cares? I can just right click and save it. And now
Right.
that image is mine. So I'm sure NFTs were lot harder to explain than
Yes.
probably even
Yes.
Bitcoin and Tether.
Because what you have, you have to explain that you can make a screenshot or a picture of the NFT, and that's fine. But it doesn't take away from the fact that if I send you an NFT, you know that that blockchain based NFT is the genuine article. And you can take a picture of it just like you can take a picture of the Mona Lisa,
Right.
right? But that's not the Mona Lisa. Now, in the physical world, we feel it, we touch it, and we say, oh, this is genuine. Of course, the reality is you have no idea if it's genuine. I have not yet found a counterexample to this, but I do believe that, for instance, an NFT, so a tokenized asset, I don't think there's anything else in the universe that has this trait to it. The fact that I can send to you, I can be anonymous. You don't even have to validate who I am, which is often the way we validate, we get trust in the digital world, right? So when something comes from Amazon, we trust it because they've invested in their brand. Well, when I send you an NFT, not only do you not have to trust me, but you don't even have to know who I am. All
Right.
you have to know is that object is on this blockchain and it was hatched from this smart contract, the original smart contract that birthed that NFT. And therefore, when you give it to me with no effort, no time spent and no cost, I know it's a genuine thing. When you apply that to money, it's extraordinary because money, of course, is one of the most counterfeited things on earth, right? North Korea funds a lot of its budget by counterfeiting
US dollar.
euros and dollars. So the reason why I've said, for instance, that all countries of any significant size will have tokenized their currency in 10 years is because it's one of those rare situations where there are no drawbacks. Like there are only positives. All the problems we have with currency can be basically removed once you tokenize it. I wish I could have spoken to more members of the US Congress after the failed and awful attempt by Mark Zuckerberg to explain why he was doing Libra. Remember, they were
Right.
going to do this stablecoin. And the members of Congress grilling him all took it as though he was inventing a new currency, when in fact, all he was doing is he was ensuring that the currency was perfected and uncopyable. And
Right.
in fact, it was like an improvement to the US dollar. But I remember watching him and being depressed about it because it was clear he knew nothing about this. He had been given some talking points. I assume all he cared about at the time was the whole metaverse stuff. And he was grilled by Congress. It would have been much better if they had grilled somebody deeper in the organization who understood what they were actually trying to build. But as you remember, he voluntarily decided to walk away. Crazy enough, right? Because now you have so many companies who have launched their own stablecoins.
Right. And I think there was so much focus on like the basket of assets. You remember that was what everyone was talking about. What's going to be in the basket? There was no discussion around the technology, just like what's the underlying asset he's working with, and everyone making sure like is their asset going to be in that basket, and how do they protect the value of their asset
Yeah,
that is in the
and even
basket?
that, you know, the right answer was, look, you for video game virtual item trading, we settled transactions in dozens of currencies. So you picked the currency you wanted, and that's what you would get. Now there was a currency conversion cost to it, but you could do it. Yeah, his answer should have been, look, a lot of people would like dollars, but some people would like yen or RMB or pound sterling or whatever, euro. You know, we'll give them what they want. But you're right. The basket thing made them feel like, oh, he's going to try to like manipulate the currency or something.
Right.
Like, dude, George Soros does that every day, and no one seems to care. But
Now that you've explained the NFTs, that makes a lot of sense to our audience. But then why did the NFT market, like, what were the reasons that you felt that would contribute to the downward spiral of the NFT marketplace? Was it just too much speculation, greed? You had a bunch of people that were able to spin up an NFT and make $1 million because they sold 10,000 of them at $100 a pop. What was was there anything that
yeah,
you saw in the background that you're like, oh, it's definitely speculation, but there's some unique thing that was happening that maybe not many people have talked about?
yeah. So what I would say is, we came up with the idea, by the way, of tokenizing game skins
Mm.
before we came up with the idea of Tether. Like, we came up with the idea in 2013. We're like, wow, what if we could do? But there was the consensus mechanisms at the time, everything was proof of work. It just, the cost, something that, again, even crypto people didn't seem to understand was how you clear the queue when you get a lot of transactions on a chain. And when we finally found a consensus mechanism, I still think it's the best one, delegated proof of stake. In 2017, we then said, okay, we can do WAX. And so, probably not even well known, we were transacting hundreds of millions of dollars of NFTs, which were tokenized skins, a month in 2018, 2019, 2020. But nobody knew about it. Like, you had to be a gaming person, and that's, a separate thing. And then I think I've always thought we probably kicked off the mania because we did a deal with the Topps trading card company who had done baseball cards. I always wanted to do it with them. And by the way, very painful working with them because they could not understand blockchain. It was 18 months. And I literally was just like, you'll do nothing. I'll just give you a piece of the transaction value.
Right.
Like, you have to do nothing. Just give us a stupid license. That's it. And it took them forever. But we thought that, I told Topps, I think we should sell out. We had like 50,000 or so, and we put them in packs, right? So for people who remember the old baseball card packs, pack of 5 with a piece of bubble gum.
Yeah.
So we put them in packs, but we also did something else because we wanted consumer mass market. The packs were $10, $25. And then there was rarities and all that. And that to me it was mostly an element of entertainment. You'd open this digital pack. Then we did Garbage Pail Kids, which Topps owned. And a lot of people were nostalgic for Garbage Pail Kids.
Those were my two favorite things: baseball cards and Garbage Pail Kids. Like, that's
They're
like,
fun.
bring me back down to 1989. Like, that was my jam.
Yes. And people like millennials really loved it. But you were putting $10 to $25. It wasn't a big deal. And so I said to them, in 60 days, we'll sell it out because, look, the Ethereum crowd sale took 60 days, right? So whatever. And within 24 hours, we had sold out all of them. And then they were like, oh, wow, this sounds great. By the way, I asked them the day before the drop, I said, can you, in your official Twitter account, just mention this? Absolutely not. I was like, why? Well, because it might fail. We don't want to be embarrassed. Give me an effing break, right? So, of course, right after it succeeds, there's now there's like 10 fathers within Topps of this project. Oh, this is everything. But now to get to your question. So suddenly a lot of people realized something that I knew because I was in the video game trading business, but they didn't. Most people thought, most blockchain developer guys, especially in the gaming sector, they thought you needed to create a game. You would pre-sell these NFTs, and then hopefully people would buy them. And then you would build the game from whatever you pre-sold. And I was like, guys, the trading people don't care about the game. Right. They just want to trade. It's just like, being on eBay or any other trading hub, right? But I had that experience because we were running video game item marketplaces. So what happened is suddenly people thought of it as kind of a gold rush. Oh, we can just make these items. And then, of course, everybody tried to do it on Ethereum. And I was like, you guys, the reason we did WAX was because Ethereum doesn't scale because of the way it clears the queue. is based on like the Uber surge pricing model. You just pay more.
Right.
And so you remember the $100 gas fees and all that.
Yeah,
Well,
and that money, even if when you don't get the NFT, I think that was the part that caught people off guard. It's like, oh, I just spent
right.
$150 and I still didn't get the NFT. Is this
Yeah.
how blockchain works?
That kind of sucked. But then obviously mad rush in, and I saw it, right? And just prices started skyrocketing, and ridiculous actions like OpenSea raising money from frankly clueless VCs at $10 billion valuation or whatever it was, right? And I'm like, guys, I've been running video game marketplaces for like 15 years. You can make these marketplaces for like $100,000 and there's no barrier to entry. So you do not want to be paying $10 billion for some random guy's thing. And, but it was also clear that it was what I believe it was the first mass market, consumer mass market object, blockchain related, that the average Joe could figure out.
Right.
And, a typical blockchain conference at that time would have like 300-400 people attend, 500, whatever. If you got 1,000, that was amazing. And I started going to conferences with an NFT focus where there was 10,000 people.
Right.
So there was a mania, and all of these, I don't know if you call them scammers, but these opportunists started saying, I'm going to do this, I'm going to do that. I had been talking to a lot of IP holders, right, in the entertainment industry and whatnot. And there's been a long tradition in the gaming industry of paying a license and getting a likeness of something, right?
Right.
And we were getting these licenses for reasonable royalty rates, 10%, 15%, 20% of the transaction value. And like overnight, all these scammers, after they saw what happened on Tops, went to these guys and were like, we'll give you 80%. Now, there's no reality where you can give the license or 80% of the transaction value, and that's a sustainable business for you. And so, but they raise money from VCs and they're like, whatever. So WWE, and all these other groups, NFL, whatever. And so in 2021, when I saw this, I was like, all right, obviously this is going to, when the bull market ends for crypto, the speculative bubble of NFTs is going to end, and then it'll be over. And that's exactly what happened. And so in people's minds, NFTs are pretty pictures, right? Or they're snippets of a video. But as we've talked about, an NFT is just a wrapper to take some digital file and enshrine it in a way that it can never be manipulated, edited, changed. That means that there's lots of things that will be turned into NFTs, passports, any kind of identification, records. Most of these things should be turned into NFTs. But the NFT sort of focused kind of faded because everyone was like, oh, NFTs equal pretty pictures, and no one wants those anymore. Whatever the prices of like CryptoPunks and Bored Apes, remember, over $1 million some of these idiots were paying. And now, I think most of these things have lost 99% of their value, which is why from the WAX perspective, our view was like baseball cards. You open up the pack, you got some fun out of the experience. It's like a scratcher, right? Like on the lottery. That there's an entertainment value, and whatever, $10, okay, whatever. But you're going to spend hundreds of thousands of dollars. Like then it gets out of the realm of entertainment into, I don't know what, gambling or something.
And it's not accessible. Like when I think, like a perfect example is like for me to go buy a baseball card, the convenience store used to have baseball cards. You buy them at $2.99, $3.99 a pack. You can't do that anymore. They don't sell them anymore. You have to go and get these like 50 card, 100 card packs,
right?
These specialty packs. And I think you've approached the industry in the same way, where you want to make it accessible for people that want to just go and invest in NFT and have some fun, where everyone else is like, hey, we have these like premier packs, you have to buy $150,000 worth. It kind of loses that engagement after a certain time when the hype dies down. Would that be a
Right.
good analogy to for the situation?
Yeah.
Especially because like Wax feels like the place, the convenience store where you can just go and get it versus like having to drive all the way across town now just to get a simple pack of cards for your kids to see what baseball
And
cards
this,
used to
you're
look like.
right. This was exactly the reason when I first said, okay, we have to build our own chain. Now that seems obvious to people because there's lots of chains, but people were like, well, why can't you just use Ethereum? And again, I said, well, because it's capped. I mean, you can do 10 transactions a second. And if it gets any kind of congestion, the gas prices could go up 100-fold. That's not a place for doing. If you have a $5 pack or a $10 pack and you're paying $25 for the gas fees, it doesn't make any sense. And like a lot of things, it was very hard to get that message out until people started going in 2021. That's like 4 years later, right? After Wax was launched, they're like, oh my God, Ethereum doesn't scale, right? I do think Solana was very well timed, and timing is very important. Solana launched, and then of course had Sam Bankman put $4 billion of speculative capital, behind it to drive the price up. But Solana launched as, quote, the Ethereum killer, right? Well, all of the better consensus mechanisms, new blockchains, even a Tron, for God's sake, could scale much better than Ethereum could, but it wasn't in people's mindset yet, right? But that moment where they saw what happened, they went, oh shit, it doesn't work. What's the next best thing? And that was a very good time for Solana because it was, relatively new. It was maybe a year old at that point, and it could say, oh, look at, we can do this too. Even though initially, of course, Solana was such a strange thing to me because the website would go down or the chain would go down like every 2 weeks. And I remember thinking, wow, in the history of Wax, right, which launched in 2018, in the entire history, now it's whatever, 8 years, there has not been a day, an hour, a minute of downtime. Like 5.9 reliability plus. There's never been a downtime. There's no reason for a blockchain to go down. But the future of the NFT, it might be a rebrand or whatever, but basically people will use blockchain-based systems to secure and tokenize all of these assets, what we now call RWA, real-world assets.
Yeah.
But probably the people creating those won't call them NFTs because the term NFT is too closely aligned now with like Bored Ape speculative madness.
Right.
And so I don't expect a return to that, by the way. I don't expect like, oh, these NFTs are going to, Bored Apes are going to be worth $10 million again. I just don't see that. I think that was a time and a place, and real world assets now, which is what, we were trying to usher in with Wax. It was based NFTs and video game virtual items and real world assets like tokenizing cash, like Tether. That has taken, I must say, I've been right about a lot of things in crypto, but not that. It has taken far longer than I thought it would. I thought the mass adoption of real world asset tokenization, frankly, would have happened around 2020.
I feel like we had like security token offerings, which was like a little bit of like a glimpse of that, in I believe it was 2018, 2019, but we didn't see really that take off either. And that was kind of a rebrand, I think, from ICOs. But let me ask you, William, talk to me like,
true.
Hit home. You're an entrepreneur. You're building all of these things, consensus mechanisms that work. Everything on Wax seems right. But then you have like Dapper Labs comes in, OpenSea comes in, Solana comes in, and it just feels like they're just marketed better. You know what I mean? They're the beautiful girl in the shiny dress. And you're like, hey, we've been doing this technology for years. It works. And you're a trusted person in the space. Your track record's phenomenal. What do you think about seeing all these other players like get a boost or, hit these hype cycles? And maybe, although Wax had Wax was something I remember very early in NFTs, especially around those two projects. Do you feel like it's getting the recognition, or maybe just shed some light on some things that you guys are doing, especially the millions of dollars worth of transactions that people may not even know about because they're so focused on Pump Fund or Solana.
Yeah, I would say you might remember this because you've been in space a while. We used to talk about this word called utility, right? Like, does this thing have utility? And again, the WAX guys, we came from video game virtual item trading. So we were trying to create an entire complete system. Think of it more as Apple, like an Apple system versus like Microsoft in this way. Almost all chains up until WAX were built as general purpose chains. What that meant to me was like guys would build a blockchain but have no freaking clue what people were going to use it for. It's like, I don't know, well, just try it out. So we were very sector focused. We're like, hey, we need to get skins, video game skins, and other types of NFTs, in-game items. This is what we want. We want to tokenize assets. We tokenized hundreds of millions of dollars of things like sneakers and other collectibles, real world collectibles. And then you would trade the tokenized version of that. And then in the WAX wallet, you could hit redeem and get it sent to you, the real world. Cool. So we built WAX to be essentially no cost or incredibly cheap to use, right? Like gas fees of insignificant amounts, because our thinking was we want this open platform that anybody can trade consumer oriented items. Now, and WAX to this day is, I haven't looked in the last week or so, but it was number one for number of transactions for most of its life. Solana now has passed it, but because of meme coins. But to put this in perspective, the Bitcoin blockchain, I don't have to look. Ethereum, I don't have to look because it's always the same. It's about a million to daily transactions. That's all it's ever been. It's just what it does. WAX would do daily transactions during the NFT phase hype of 25, 30 million transactions, like 25 times. And a slow day for WAX would be 5 million transactions compared to, a million on Ethereum or Bitcoin. Whereas the miners on an Ethereum during that time were being compensated $600 million a month through gas and then tokens. Our people, the people running the chains, were the block producers, we call them, were being compensated $1 million for instance. So if you think about it from an economic standpoint, to run our chain was extremely capital efficient, right? But let's now go away from utility, which is basically being able to do a lot at a very attractive price. What the industry kind of evolved to was more token speculation.
Right.
So for a lot of those companies you mentioned, they took venture capital in and then they boosted their token with the venture capital. But you might remember in 2020, 2021, these ridiculous amounts of capital that blockchains were raising. And, the thing about blockchains is they're very capital efficient. So it's like, why are they raising hundreds of millions? Well, for most of them, that money was used to buy their token to keep the price high, right? And so I think that now, if you look at the top 100 tokens, for instance, by market cap, here's a funny one, like 10 of them are like bankrupt companies or whatever. I mean, I think FTX's token is still a top like 75 token. The company was literally, all the guys were thrown in jail and the company declared bankruptcy. But these tokens stick around. Meme coins come, which by definition, no utility. So the industry has shifted to pure speculation. And for instance, if you, as a parlor trick, if you ever talk to somebody who invests a lot in blockchain, if you ask them like, what metrics are important? Most investors would say, absolutely. And then you say, okay, well, how about transaction volume? Is that an important metric? Absolutely. Can you name the top 5 tokens top 5 transaction volume blockchains, I'm telling you, almost no one can, because no one really looks at it.
Right.
It's so you either look at a chain as a utility oriented thing, or you look at it for speculation. The industry has really gone towards speculation. And by the way, I'm a capitalist, so I understand that. But the negative side of that then is you're not compensating any builder to build in utility and real world capability.
Right.
I
And then
hear
the only
this.
person that gets hurt is the customers that bought these. They're the only ones that pay the ultimate price, right? Is
Oh
the
yeah,
people
well,
that
this is
invested
true
their
for,
money.
yeah. But you'll hear teams that have built blockchains. You hear this a lot with Ethereum guys. They do this massive release with all these new capabilities, and it's sort of like a meme in itself. After they release it, the token drops in price. And you're like, wait a minute, why did the token drop in price? We just created all these capabilities, because the reality is most people don't use those capabilities. The most action in the crypto industry is on the exchanges. It's not businesses or entrepreneurs or individuals using the blockchains, right? Just like take away meme coin trading, the transactions are not interesting, right?
We like shiny, man. We don't like utility. It's like, I think that reflects society though, right? Like, we all know how to get in better shape, right? We eat well, we get 8 hours of sleep, we exercise a little, but everyone's doing saunas and cold plunges and Ozempic. Like, nobody wants to do the easy thing. We want to do the thing that we can tell everyone that we're doing. And I think that reflects a lot in the crypto space. We
You're
want to do the
absolutely
shiny
right.
thing that looks more exciting than actually doing, what I guess is now considered the traditional boring thing, which is like Bitcoin and functionality like Wax blockchain.
Right.
We have a few
Yeah.
minutes left. I want to talk to you about regulation, especially around stablecoins. You're a co-founder at the time of Tether. Did you know that the space was going to be regulated like this? What do you think of the current regulations that might be stifling some of the innovation and turning the functionality, to your point, turning the utility of a stable coin, and now having very similar regulations put upon it that traditional banks have with large reserves, which kind of steal or stifle the innovation that the stable coins, especially those getting into the countries that you described earlier?
First, I'd say, the word regulation is such a vague word, right? It's just, I try to always avoid it because I'm like, I don't know. There's a set of rules that different societies have imposed on businesses. Whenever I hear people say, "Oh, crypto's unregulated," I'm like, dude, you're insane. Like there's thousands of regulations that crypto companies have to abide by. There may be some that banks abide by that crypto doesn't, or that stock issuing companies abide by that crypto doesn't, but that's because they're different beasts. So the best form of regulation is transparency and accountability, right? So the Terra Luna had neither of those, right? And it was also based on for your audience, there's 3 ways to collateralize a stable coin, and Terra Luna picked the worst way, right? And it failed. It was bound to. So the Trump administration has been mostly, I think, supportive of stablecoins, though funny enough, they're quite negative on the idea of the Federal Reserve or a central bank issuing a stablecoin. I'm not quite sure why, but that in the end, as I mentioned, all fiat currencies, all central banks should ultimately issue their currency in stablecoins. But if we look at the current new sets of rules that are being imposed by not just the US, but by other nations, and then the voluntary compliance with things like KYC, know your customer, and anti-money laundering, I think those are mostly quite good. Tether is sort of an outlier. It's the first stablecoin. That's the category. And it now publishes essentially a balance sheet that shows what's behind it. I believe all stable coins should have a proof of reserve, a proof of backing This is something that the existing stablecoin legislation in the US calls out. And I agree because it's very easy to do. It's easy for people to implement that. And the likelihood is that I would say many, I don't know if at all, but many multinational companies over the next 10 years will have their own stablecoins because it makes so much sense. They're a good thing. The area where stablecoins actually are the most valuable is also an area where most people never really delve into, and that is the enormous currency conversion costs that most of us have to pay, and we do it without really understanding what that cost is, right? Because there's about $100 trillion global economy in the world annually, and about 1 trillion of that is sucked out by currency conversion costs, which are basically profits captured by about 5,000 global financial institutions that have special relationships with their governments where they're allowed to be currency traders. And so what's beautiful about tokenizing, and let's assume all stablecoins are tokenized, is that you never have to convert. I can send someone in Japan tokenized dollars, and they can hold those tokenized dollars and then use those to buy something with anyone around the world, never having to bear the burden of the currency conversion. And this is why I think lots of multinationals, anytime you do cross-border settlement, you're paying this currency conversion cost.
Even within their own organization, you mean? So it makes sense for these organizations to have a stable coin, so they're not, just transferring funds is costing them these days.
Yeah,
versus...
if you're earning most of your money in yen, but you're paying some workers in California in dollars, you're having to convert, right? Now, not everybody wants to have all of their currency tokenized, right? Until we get to a point where you're freely able to spend and pay for anything. But businesses for sure would love this. And I think it took even payment companies like PayPal, it took them 15 freaking years to finally go, it took a long time for these businesses to go, wow, this stablecoin thing makes sense. And the reality is, Tether is the most traded crypto on earth. And I think stablecoins are the real story of blockchain. Stablecoins are going to become the most traded, they're already the most traded asset, but they will remain and even grow in trading volume. I think that's the biggest contribution blockchain has provided to the world, is the invention of stablecoins. And they're not going to go away. And once the US has a regulatory regime around stablecoins, every other major company is going to go, US is doing it, we're going to copy.
Yeah. And that's always the biggest part, is like, if you're dealing with the US and you really use it in the way you want to, it's kind of hurting, a lot of your global business. Yes. And to your point, that was the ethos of crypto. When I first got in 2016, everyone was talking about banking the underbanked and the unbanked. And we never really seemed to fix that problem until like stable coins were widely used, where we see like, you can't just go into a Nigerian bank and ask for US dollars. You may never get it. Versus like, hey, if you're in the US, you can get access to cash of, all the different countries. But, there's places around the world where the US dollar is almost impossible to obtain. And that's hard to do business if you can't send funds in USD.
Right. Yeah. Believe me, we could have a long conversation about
William, I feel like we need to come back. You need to come back on maybe in a few months, and let's do a part 2. We've run out of time today, but tell us anything that you're working on, whether it's wax, anything that you're seeing or excited about in the industry, AI. Tell us something, leave the audience with a little bit of a teaser for our next conversation.
Well, let me go 2 ways on that. So wax is I still am excited and confident in video gaming, which is like the largest consumer activity in the world. There's like 3 trillion people who do video games. I'm still very excited about what blockchain can do for video gaming. But as I mentioned at the beginning, the UI problem, the inconvenience problem, I think has stifled a lot of that. So Wax is still very focused on video gaming. It's the reason it's still top 5 or 6, sometime number 2 chain daily in transaction volume, especially when you take away memes. So that's, but it hasn't taken off. So we're very focused in that area. And then 2025, as you know, hopefully everybody here knows, this was supposed to be the post 2024 Bitcoin halving bull market. And so this has been the most important year in the last 4 years. And traditionally, at the end of that bull market, which if past patterns persist, would end in November 2025. It's about an 18-month cycle from the beginning to the finish. So it started in April 24, the halving for Bitcoin, and probably would end in 2025. But we really haven't seen it happen yet. So this is worrisome, but we're in a new era, I think. If Bitcoin doesn't hit 200,000, I would say by the end of April, and I'm not predicting it will, I'm just saying if it doesn't hit 200,000 by the end of April, and I know that would mean it would more than double, so probably unlikely, but then we are definitively off this very consistent prior pattern we've been on, which means we're in unknown territory. And so call it September, October, maybe we'll be talking then. If Bitcoin hasn't done that, and remember, wherever Bitcoin goes, all the alts follow, then we will have had a post-Bitcoin halving cycle where we didn't get the bull run. I think that means 2026, if it doesn't happen. If it does, we're good. If 2026, who knows? Wall Street may lose interest, right? A lot of people may lose interest. We might have a reshuffling. Maybe it goes back to utility and less mad speculation. I don't know. But this year is so important because of this. Why would you hold Bitcoin if it doesn't rise much more than what you could get out of a traditional stock, but you have all of the volatility and the difficulty of using it? So I'm still focused on us achieving this post-Bitcoin halving pattern, but I'm aware that if it doesn't happen in a good way, people who are sort of like, I want to come in when things are shaken up so that maybe I can take advantage of some new vector the industry goes, that could be in 2026.
I love it. And I think, the only thing about utility, every utility token had very little utility. Everyone that pronounced themselves as a utility token had very little utility. I think, utility is in the people that know what you're building at WAX.
And let me just say, you're exactly right. When we did WAX, this was the reason, because we did it the same way we did the marketplace. We built the blockchain. Then we built the wallet. We were the first to allow you to use very simple things like OAuth for sign on, sign off, really easy to use. And we created the marketplace. So we wanted it's like Apple coming and saying, we're going to give you the phone, we're going to give you the apps, we're going to give you the payments to do it, a complete system. If you just give people a chain and say, build something, that never works. So these kind of industry targeted chains that allow you to do a useful utility, maybe when mad speculation starts to fade, that becomes much of a bigger focus, which I think would be much better for entrepreneurs. Because how the hell do you know if your token's going to pop or not, or be manipulated by some exchange? You don't know. But what you can control is how well of a job you do in allowing people to do that utility that you think they might want to do. And so maybe that's where blockchain starts to head, which would frankly take away a lot of its criticism, because you're right. Most utility tokens, how many times did we see in the 2017 ICO or 2020 ICO bubble where people were like, we allow you to use our token as a payment mechanism? Right. Really? Like, that's your fucking innovation? Like I can do that with anyone.
Such a great point. William, where can people find you? Where do you express similar thoughts? And what a powerful point to lead off about what could happen in 2025 and 2026. I think that gave a lot of people something to think about. But where can people find you if they're just like, hey, I need to reach out to him and keep tabs on William's thought leadership?
I will say, mostly I talk on podcasts or, CNBC or stuff. I mostly that. I do have a Twitter account, which is at William E. Quigley, where I publish stuff, but I am not like you. I am not creating a lot of content. I probably could, but I've been busy building stuff. And as you know, this is a full-time job. Content creation is a full-time job.
Full-time job. And I appreciate that you're working on the building, so content creators like me have interesting people to talk to. Otherwise we're just talking heads, talking to other content creators, and nobody has anything of utility to talk
I do
about.
often want to say more stuff, but then I'm like, we talk, what you do takes a lot of discipline, a lot of work, a lot of prep, right? So maybe if crypto doesn't go the way everybody's thinking it will, I'll have a little bit more time.
William Quigley, the content creator, 2026. Look out for
Right.
look out for William. Thank you so much for joining us. We will have you back in a few months, and we could talk more about some of the predictions you had earlier on. Talked a little bit about AI, get deeper into delegated proof of stake, because I think that's such an interesting concept. And maybe even touch on, like, is Ethereum losing its luster? I know you made that statement. So many more interesting things to talk about, you, William. Thanks for joining the Around the Coin podcast. We can't wait to have you on for the 3-peat.
You're welcome. Thank you.